Good evening, ladies and gentlemen. A very warm welcome to all our participants, dignitaries, and esteemed speakers to the panel discussion on inflation outlook covering three C's: crude, currency, and crops, organized by IMC Chamber of Commerce and Industry. All participants will be muted to avoid any disturbances during the course of this session. To consume less bandwidth and have clarity, you are requested to stop video streaming at your end. Kindly post all your relevant queries in the chat section so that the same can be addressed. As we begin this session, may I request Mr. Rajiv Poddar, President, IMC Chamber of Commerce and Industry, to present the welcome address. Over to you, Mr. Poddar.
Thanks, LB. Respected speakers, distinguished guests, ladies and gentlemen. On behalf of the IMC Chamber of Commerce and Industry, it gives me immense pleasure to welcome you all to today's panel discussion. A very warm welcome and special thanks to our speakers, Mr. Atul Joshi, Mr. Raj Nair, Mr. T. Gyaneshekharji, Mr. Madan Sabnavis, and Chandrasekharji. The Indian economy continues to struggle following renewed concerns over the spread of the pandemic. The second wave has hit the country like a tsunami and affected both cities and rural India. India's CPI inflation decelerated sharply at 4.29% in April 21 from 5.52% in March 21. CPI inflation is expected to moderate towards 5% in FY22 and 6.2% in FY21 as expectations of normal monsoon, bumper harvest, likelihood of downward adjustment in fuel taxes, and favorable base effect would offset the upside emanating from higher global commodity prices. Let's look at the three C's very briefly before our experts give us insights. The first C, crude. Internationally, Brent crude oil prices averaged at $65 per barrel in April 21, being close to January 2020 levels. From a low of $9 in April 2020, the significant rise is primarily due to the rising demand for crude oil due to the pickup of the economic activities globally. It is projected to average at $65 per barrel during the second quarter of 2021 and then fall to an average of $61 per barrel in the second half of 2021, according to the US Energy Information Administration's short-term energy outlook released on 11th this month. The second C, crops. The Indian Meteorological Department forecast of a normal southwest monsoon this year is of course a big relief. Satisfactory rain would help harvest decent kharif crops, boost our rural economy, and help contain food inflation. Finally, the third C, currency. In the beginning of April this year, the rupee was quoting at around 72.5 per dollar. After the monetary policy was announced on 7th April, the rupee fell sharply from 72.5 to beyond 75.3 per dollar. Of course, the correction did not last long, and the rupee bounced back to 74.05 by the end of April. The main reasons for the rupee drop down over 4.3% were mainly due to the growing COVID-19 concerns, its impact on the economy, and the RBI monetary policy. Where are the crude markets headed? Will the rupee weaken or strengthen? What are the kharif crop prospects? Let's get insights from our experts on the three C's, crop, crude, and currency. All these three C's are very important, and they have an impact on three other C's: cash, corporates, and our country. Before I conclude, a few words about IMC. Established in 1907 and having its headquarters in the heart of the city of Mumbai, the IMC Chamber of Commerce and Industry is the apex chamber of commerce, trade, and industry in the Western region. It has a membership base of over 5,000 and over 150 trade associations affiliated to it. Together, IMC represents and advocates the interest of over 4 lakh businesses and industry establishments across the country from diverse sector of industry. Importantly, IMC is a SEBI accredited training institution for commodity derivatives. IMC, in association with BSC India, continues organizing regular seminars on gold, commodities, and markets. The same has been highly successful, and 24 more such seminars are planned in this year. Once again, I welcome you all to this contemporary and thought-provoking discussions. Thank you for joining us. Thank you.
Thank you, Mr. Poddar. I now request our moderator for the session, Mr. Atul Joshi, founder and CEO, Oyster Capital Management, to present the theme address and then take us through the panel discussion. Over to you.
Thank you. Thank you, Selvi. Thank you, Mr. President, for setting the tone of today's session. Inflation outlook with the 3 C's, crude, crop, and currency. One of the key things that the central bankers over the last 100 years have debated very intensely is whether it is growth versus inflation. Where is the choice? And it has been swinging like a pendulum. Sometimes it's the inflation, sometimes it's the growth. But this time, around the world, thanks to the pandemic, I think there is no discussion of the choice. The choice is unilateral. It is growth. That's it, period. No discussions on the inflation front. But the question is that how long can it last? How long the central bankers can keep the growth as a priority? And while they continue to monitor inflation, is that something that is under their control is a question. There are a lot of cost push inflation indicators that are emerging in the world, whether it is the prices of the iron ore or crude, or it is crops, corn, oil, various things are impacting. And now you have certain developments in geopolitical situations. Onshore here in India also, there are several developments which have happened. Pandemic is just one of them. And we are impacted a lot by the way our geopolitical situation, whether it is the Kisan Andolan or it is the pandemic driven, shutdowns, etc. There are several things which impact us. Now we need to look at each of these 3 pieces from our experts and then assimilate all of it with the help of a very renowned economist in the country, Mr. Madan Sabnavis, and he will share his views with us. Today's program, I intend to plan it in such a way that initially we will have each of the speakers make a presentation about a specific part of the 3 C's, crude, currency, and crop. We will have Madan Sabnavis giving us overall macro presentation on how all of these will assimilate. What are the other macro factors that influence the inflation outlook for 21-22? And after that, we will follow it with a question answer session. So we would start with our presentation on the crop first. I would request Mr. Chandrasekhar to start this session off. Mr. Chandrasekhar, let's take about 8 to 10 minutes to complete the initial presentation, please. Over to you, Mr. Chandrasekhar.
Thanks. I have a few slides to show. I'll share screen very quickly. Yeah, here it goes. Yes. All right, slideshow. Thank you, Mr. President, and thank you, of course, the moderator, Atul Joshi. Mr. President, I want to thank you particularly for mentioning again that IMC is a SEBI accredited training institution for commodity derivatives. Over the last several events, we've been repeating this, and there are some positive developments which I'll share with you later offline. We are today on this inflation outlook and 3 C's. I'm going to talk over the next 8 or 10 minutes, as the moderator mentioned, about the Kharif crop outlook 2021. And Mr. Moderator, if when I reach 10 minutes, please alert me, and I'll probably I'll of course have to conclude quickly.
So you have to just okay,
done. Okay, all right.
Now, very clearly, southwest monsoon is a critical driver of farm output, as all of us know. And in the Kharif season, the most important crops are paddy, which is rice, pulses, coarse grains like maize, oilseed, soybean, groundnut, etc., and cotton. Oilseeds and cotton are, of course, cash crops. And particularly, this monsoon is important for rural incomes. The India Meteorological Department has forecast normal southwest monsoon for 2021. It continues from 2019 when we had a normal monsoon. In 2020 also we had a normal monsoon. In fact, in 2020 we had the benefit of La Nina, which means well, excessive precipitation, and therefore in 2020 our monsoon, southwest monsoon, was 101% of the long period average of 880 millimeters. This year it is just normal, and we don't have the benefit of La Nina. And when I looked at the IMD forecast more closely, the probability of above normal rainfall is only 60% this year. Last year, the probability of above normal rainfall was 70%. But that doesn't change much really. Even a 60% probability of above normal rainfall is good for the country. But we have to be prepared to expect a slightly less munificent rainfall than it was last year. It will not be 101% of the LPA. It could be 98 or 97 or even 96% of the long period average. And therefore but that doesn't change much, but we need to remember this. More important is the temporal and spatial distribution of rainfall between June and September, which is critical. The quantum of rainfall in each of the months and the geographical distribution, south, east, north, west, central India, that forecast will come from the IMD in the next 10 days, I expect, definitely before the end of the month. And that will give us a lot more insight into how the southwest monsoon is going to pan out, whether there are going to be some regions of dryness, or there are going to be regions where there could be excess rainfall, etc. We still don't know. We need to wait for it. But as of now, it is normal precipitation, and we should assume that there'll be reasonably good, satisfactory temporal and spatial distribution of rain between June and September.
Hello, I think we have lost connectivity with, yeah.
Okay, all right.
Yes,
done.
sir, please continue.
Okay, so, all right, and okay, therefore, we had the phenomenon of La Nina last year, which brings excess. It has an opposite effect in South America, Brazil and Argentina, etc. There, they had dry conditions, and therefore their wheat crop, their corn crop, their coffee crop, their soybean crop was all affected. And therefore that is what has created very tight supply conditions around the world for major agriculture commodities. And rising crude oil prices, as the president referred to, are also obviously contributing to the bullish sentiment in the agriculture commodity markets. And therefore, because Indian market is integrating or is integrated in the global market, we are not insulated from global influences, global factors, and actually, what should I say, impacting the Indian market. No wonder we found in the last several months, oilseed prices have risen very sharply. Soybean prices are double, 100% more than the minimum support price. Pulses prices have gone up this year after 4 years of stagnation. Cotton is up, maize is up, and they're all far higher than this time this time in 2020, that is last year. Okay. Sylvie, my slide is not moving. Sylvie, the slide is not moving. Can you help?
So please share your presentation, sir.
Yeah, okay, I think it's going now.
Sir, it's
Okay, I think it's done. Okay.
Yeah.
Therefore, global factors are impacting Indian prices, and Indian crop prices are quite high, whether it is maize or soybean or cotton or whatever. Now, I'm giving in this slide Kharif production target for 21-22. The planting for which will start in June, and of course, harvest will be in September, October. And there are the major crops are listed. The target for rice, pulses, coarse grains, oil seeds, cotton, sugar, sugarcane. In fact, yeah, all these numbers are given. All these numbers are in tons, except for cotton, which is of course bales of million bales of 117 kilograms. For we can very clearly see that this year the government has actually raised the production target. Whether this higher production target is likely to be achieved is of course a question mark. There are concerns, there are challenges. I'll come to that, but what we need to understand is pulses prices have gone up substantially. Cotton prices have gone up. Oilseed prices are up. Maize among core cereals, maize prices are up, and all this is going to send out a very positive message to the growers, and it's going to these prices are going to motivate growers in India to plant more. Now, what will be the price impact of these numbers? Obviously, as I said, current high prices are certainly going to encourage Indian growers to plant more in the Kharif season. And I expect personally a higher planted area for soybean, for maize, and for cotton. And I showed those numbers. For example, cotton last year was 12.5 million hectares. It has the potential to touch 13 million hectares this year and even marginally cross that. Maize acreage was last year something like 6 million hectares.
Sir, sorry to interrupt, but we are not able to see your slides. Will you please show your slides again? Slide share.
But can you see this?
No.
Can you see this?
We are not able to see your slides.
Okay, all right. Then we'll share the slides later because I'm able to see it. I'm moving the slide, but we'll share with all the participants this presentation. I don't see that. Okay. Now we can expect higher acreage for a number of crops like soybean, maize, and cotton. But there are challenges, and I want to talk about the challenges. One, the admitted position of the government of India is that seed availability is tight as far as maize and soybean are concerned. What the actual available seed, planting seed, is short of the availability is short of what we need or what this country needs, what the crop needs, and that can potentially impact acreage and yields, because I also think there is a possibility substandard seeds may also be used like we saw in soybean last year, and for that's a risk which we need to take on board. Second is high food prices are creating a big concern in the policy making circles. So will the government liberalize import, further liberalize import? They've liberalized import of pulses only 3 days ago. The pigeon pea and urad and moong imports from restricted list have now moved to the free list. Therefore, imports are free until the 31st of October. That this is to contain inflation. Edible oil, world prices are very high, and we are seriously short of edible oil. The rate of customs duty is high. Will the government reduce the rate of customs duty? In that event, it will have an impact on domestic prices and on the motivation levels of farmers. On the other side, we also have to look at the demand. Now, festival demand will start kicking in from August August, September, October, a series of festivals will have when food consumption actually increases. But at the same time, this fresh wave of pandemic infection is also impacting demand. But this year, unlike last year, it is in localized pockets. It is highly regional or localized, the impact of a lockdown. Therefore, I don't see demand destruction to the extent that happened to happen this year. There will be some demand destruction, but not on a massive scale that we saw last year.
Chandrasekharji, you
importantly,
Chandrasekharji, you are almost there in terms of 10 minutes.
Yeah. Okay, one more minute. I'm done with this. World prices I expect will soften in the second half because there'll be a rebound in global agriculture production, particularly in the northern hemisphere. And the signals for that are already available. Wheat and corn prices have actually started to fall in the last 4 days after the USDA announced, gave its projection for 2021 crops. In India, the cotton planting is going to start very soon, or it might probably have already started in Punjab, for example. But the minimum support price for Kharif crops has not been announced at all by the government of India. So the emerging picture is fraught with possibilities. Subject to well-distributed rains, the Kharif target is likely to be achieved. Some price correction is likely due to harvest pressure, but global factors will continue to weigh on the sentiment. Whether it's biofuel policy, stock building, monetary policy, dollar exchange rate, crude oil, all these factors will certainly weigh on the sentiment of the agriculture market. And my sense is food inflation will continue to loom large. This is my expectation.
Sure.
Thank you very much.
No, thank you. Thank you so much, Mr. Chandrasekhar. Let me now invite Mr. Raj Nair to share his thoughts on crude, the most important impact which has on the India's overall current account and the import bill. Over to you, Mr. Nair.
Thank you very much, Atul, and good afternoon to you, the President, the other speakers, and all the participants in today's event. I'm going to talk about oil price prediction. I share a few thoughts on the challenges of predicting it. One easy way out for me would be to say that the current price is 65 or whatever it is, dollars, and by the end of the year, it might come down to 61. But I thought it might be a good idea to share what are the approaches I take to predict what might be the crude price and so on and so forth when I prepare my annual paper in January and try and talk about what might happen during the year. So let me do that. The important thing to understand here is that, one second. Can you see my slides?
Yeah.
Yes, sir.
Great.
Yes, sir.
So one of the important things to understand here is that if you want to figure out what the oil and gas prices are, you have to understand the relative economics, the politics behind this, and the, let's say, speculation, investment, or whatever it is. I'm just using a convenient word, future and options. All three play a major role. The whole world needs fossil fuels, but only 70%, only 30% is consumed where it's produced, and 70% is traded, which makes crude oil an excellent product to be a commodity to be traded. And therefore, it's not just the product that is traded, but a lot of financial products are traded on top of the physical product. And like in many cases, the actual physical delivery is very small compared to the total volume of orders placed. In many commodities, the actual delivery is hardly 5%. I'm not sure what it is for crude oil, but it is very, very small compared to the total volume of trade happens. Another thing to understand is that the big powers, that mean the big countries, powerful countries, have traditionally messed around with all the oil producing countries in many ways, whether it is Venezuela or Iraq or Iran or Saudi Arabia, you name it. And these big countries have messed around because they have a lot at stake. They don't want the oil price to go all over the place. Okay. And then, of course, since this is happening, there'll be prices going up and down every day, and there will be a few crises happening from time to time. Hedge funds and other speculators never waste a crisis. They jump onto it like vultures and make a they have a field day. So, in the context of all this, how does a common man, a layman like you and me, who is interested from the pure business point of view to understand what the impact on our own businesses, how do we do it? In my case, I'm interested because I'm a strategy consultant, and many of our clients, their business outlook depends upon what the prices of crude oil and currency and etc. is. Therefore, it's very important for me to understand and build it into the thinking that goes behind the strategy. Okay, so let me first take you through a journey of 2020, because it's a very interesting year where lots of things happened. And in fact, by studying 1 year, you can get a good understanding of what happened. It usually happens over a decade. So it started in 2000, it ended in 2019 with an average of $67 per barrel. I'm talking Brent. And there was economic optimism that 2020 will be better. So it started off getting close to 70. But after that, it kept tumbling down because the pandemic happened. And the pandemic happened as if it was a big surprise. In fact, if you read my last year's annual paper, that is January 2020, you would have seen that I'd called out the pandemic a month and a half before World Bank, WHO called it. And it was expected that there would be a problem. But anyway, oil prices came down. And during that period, the OPEC plus, the main OPEC plus a few other countries which are part of the club, but outside OPEC, they tried their best to see how to cut oil production. But unfortunately, Russia, which is so dependent on oil production, was not prepared to cut it. They wanted to increase it. Saudi Arabia tried its best to convince them to bring it down, because Saudi Arabia, being a major producer, also said, we will cut. And everyone cuts. Russia said no. And there was a, let's say, ego clash between Putin's rep and Mohammed bin Salman, as a result of which they went into a price war. They started producing like crazy, and the prices tumbled and tumbled and tumbled till one day in April, the prices came down to $9.12. But quickly on the 12th of April, the OPEC plus countries agreed that we must cut oil production by 9.7 million barrels. That's almost 10% cut. But over the next 2 months, because to get them to agree to do it overnight was impossible, because they can't adjust the whole economy in 2 days or 3 days. So they're given time, and Russia got a bonus. They were allowed to increase it a bit and not cut, while everybody else cut. So gradually the prices rebounded. But there was a very strange event which all of you must have come across. On the 20th April, the price of futures came down to minus $37. The producers had to pay people to take positions $37.50 per barrel, which they sold to them. Okay, so you pay to give, because the entire storage capacity in the world was full. Nobody had storage capacity. So they had to get rid of these expiring futures at its own cost. But that's a strange once in a lifetime event. But the main point is that oil prices tumbled when there was a price war, a war to sell more and more when the demand was crashing. And then when they all agreed to cut together, the prices started going up, and it went up and up and up till end of 2020. On the 31st of December, when I started writing the note for the next day at 3 o'clock in the afternoon, it was $50. At night, it closed at $52 a barrel. In 2021, it continued to rise. And even today, it's rising. That's because in the last week of December and the first week of January, Mohammed bin Salman actually conducted very successful oil diplomacy by contacting each one individually. And then they agreed, and at the joint meeting, that they will meet every month to review what America is doing, what it's capable of doing in terms of oil production, and then decide what OPEC should do. It used to be quarterly, it became monthly. So it's been very effective after that. All of a sudden, to the good luck of the oil producing nations, there was a massive winter in which affected Southern America, Southern USA, and Texas. That's called the Texas freeze. Everything froze, and there was a supply cut from US, and the prices almost hit $70 on March 5th. But eased a bit after that, and now today we're talking $65. On the economy side, the third wave has been reducing in Europe and USA. So there's a lot of feeling that things are going good. So oil prices, demand will go up and oil prices will go up. And so it's tested 65, it's little above 65 now. So what can we conclude from looking at this? That economics prices drove prices down, that when the demand crashed, down. High inventory caused a crash. There was a high inventory created by oversupply at that time. Then politics drove prices up again. They all ganged up. And finally, supply will ease once the demand supply matches. But is that all? I think it'll be interesting to see. What I will do is I will paste the same price chart, and below each, in each, there are 3 slides. In one, I'll paste below the demand pattern against the price pattern. The next one, I'll paste the supply pattern against the price pattern. And third one, I'll paste the inventory pattern against the supply pattern over this whole period. And so that we can make some conclusions. Okay, so here's the demand pattern. You can see that there is a very interesting correlation with the curve, price curve, which we saw, which is what we saw a little while ago. The diesel, jet, fuel, and gasoline demand has dropped. Jet, of course, far more than the others, but none of them have risen. They've all risen gradually, but none of them have even touched the pre-pandemic level. But the price of crude has gone to the pre-pandemic level. Okay, so there's a bit of a thing, but one can see a very lovely correlation. So we can conclude that economic drives demand, and demand expectation drives prices, and sit happy. But when you look at the next slide, you'll say, oh my God, look at this now. The supply cuts. Initially, look at the lower chart. You can see that these are the percentage of supply cut. Initially, in the first few months, when Russia and the rest of and Saudi Arabia and others were increasing supply to cut each other out, they ended up cutting each other, actually cutting themselves out, and the prices dropped. So the moment they agreed to reduce the production, inventory started coming down, supply started coming down, and you can see as the supply goes down, there's a sharp increase, then supply is down steadily, and the price also just keeps rising very steadily, and finally there's a little more of a cut, and the price goes up further. So we can say, what a lovely correlation. Polemics drives supply, and supply drives prices. We don't have to bother about demand. It's correlated, but we don't have to worry about anything else. Then now let's look at the same price chart against the inventory of the OECD, all the oil producing nations. And then you suddenly see that as the inventory started going up, the prices are coming down. As the inventory was steady, the prices were more or less steady. And as the inventory started dropping, the prices are increasing. So we can say, oh, what a lovely correlation. Inventory buffers demand supply effects. Isn't that obvious? Now, what are we going to use? Supply? Or are we going to use demand? Or are we going to use inventory to determine what the price is? Or are we going to find an interesting combination of the 3 and say QED, that's quad era demonstratum, and say we have proved that all we have to do is just these 3 factors. But the question is something else happening below the surface beyond these 3 factors? That's worth looking at. See, as I said a little while ago, the demand has not yet reached the pre-pandemic level, but the price has increased. Why? I think we should also ask another question. There's a huge number of unicorns shooting through the roof. All of a sudden, in 2020, there were good guys in 19 also, but it's in 2020, everyone and his brother becoming a unicorn. Timber prices have quadrupled in the US. Steel prices boom. Equity has gone through the roof. But why is that happening? So is oil price also going up with this, along with all these things? Now, one thing which is very clear is that the money supply is up like crazy. Forget about what Trump did. After Biden took over, he's bringing in $2.7 trillion, 0.9 trillion in December itself, and now 1.8 trillion. That's about 12.6% of the US GDP. That's a lot of money if you recognize that the US GDP is huge. And the interest rates are near zero. So free money and lots of money. So obviously it will chase all kinds of commodities, including oil. So we have to fit in this money supply thing at low interest rates into this picture to get an understanding of what will happen to prices. There's something happening to those. That's why probably it was going up. And the correlation looked as if it is fantastic with demand, supply, and inventory. Not that there's no correlation, but there are additional factors. So just look at the annual trading volume of futures and options on all the global exchanges put together. Back in 2014, there were 21 billion transactions in the year, F&O transactions. In 2019, it increased to 34, which is quite a big jump. But lo and behold, in the year 2020, when the whole world was collapsing, the F&O transactions went up to 46 billion transactions. Nothing to do with the economy. It's all to do with the kind of money that's floating around the place and the ability to, the need to take chances, because interest rates are so low, you would hardly earn anything. So riskier assets, taking positions became the norm. And if you find that equities has gone up too much, the price earnings ratio is just too high, then why not go after startups? So unicorns have gone up and oil is always there. So bet on oil. But let's look at this in a little greater detail. In the year 2020, F&O went up by 35.6%. Futures were 33%, and options were 39%. There was even a 9.7%, almost 10% increase in open interest. That's the number of outstanding contracts to the record level. 1 billion contracts were left open on 31st December 2019. Equity-related derivatives were the majority. F&O and equity indices alone, the largest category in the listed derivatives, was up by 49% in that 1 year. Energy F&O was up by 24%, agricultural F&O by 45%. And a lot of this is happening in obviously China, which is where, because Chinese are natural gamblers. So with interest rates being low, F&O activities were pretty high, and money supply was such that all commodity prices have been going up. So commodities play a major role. So now the question to us is, will US inflation happen? Because if this is the kind of money supply, logic would have it that inflation should happen sooner or later. Will that trigger a rate hike in Q4 of this year or Q1 of next year? There are experts are divided on this. There are some people who say it won't happen till 2023 just because the Fed had announced a year ago that it won't touch till 2023. But we don't know. It can happen end of this year, little less likely, early next year, more likely. But when that happens and money supply is also reduced, will all this picture change and will it bring oil prices down? And it's not just about demand and supply. Okay. So what's next for oil? The Russians and the Arabs need $60 plus to survive. I mean, to survive, to run the economy, not to afford to produce. Because in Saudi Arabia, it's only $2 to $8 depend the cost of producing oil. So even at $10, they can make money, but they can't run the economy. And they need, these two countries depend heavily, these two areas depend heavily on oil as the main revenue source. Now the thing is that other OPEC members want to increase supply because they want to increase revenue. A lot of commodity prices have gone up, their costs have gone up. They want to produce more. Can OPEC continue to curtail supply at the present level? It's a big open question. And we have to watch every month, every week in the next few months to understand what will happen. Fear that oil supply US oil supply will increase at higher oil prices. If oil prices go to 70, you can take it for granted that shale oil supply will increase significantly because it's easier, cheaper to operate them than to cap them. Also from Iran, if there's a lifting of the embargo and Biden is trying to see that they bring Iran under control, It's possible. Will speculators start reducing their positions when they start sensing that the US monetary policy will change? Will that send oil prices crashing? I asked this question in the last slide too. And every year one notices that after the heavy driving people do in summer, the oil prices drop in winter. Towards autumn and winter drop. So by the last quarter, oil price can drop, in my view, to below $60. I know that there is a very recent report which talks about $61, but I feel it can go below $21 to $60 in Q4 if there are no conflicts at hotspots. So this is the whole thing about politics. So with that, I just want you to give you a holistic view that it is not very simple to use Keynesian economics and say demand, supply, and the gap will decide the price. It's not just about inventories and speculation, etc. It's a lot to do with money supply, and not all, the very small part of the total oil is delivery, the rest of it is F&O. Okay, thank you very much. And back to you, Atul, sorry.
Thank you. Thank you, Raj. So we probably are going to coin a new word, politics and oil ticks. And that probably will describe the way the world is going to emerge. I like your last question, and I'll pick your brains on that going forward. But you mentioned a very important point was the money supply that's been increased by $2.7 trillion by the US. And that makes me bring in Gnan Shekhar here. And let me bring you in, Gnan Shekhar, and ask you to make your presentation, your thoughts, share on where do you see the impact of oil, this crude, international politics, the supply of dollars. Where do you see dollar rupee over the next 6 to 12 months time frame? Over to you, Mr. Shekhar.
Thank you, Atul. Thanks so much for having me. Thanks to all the dignitaries in the panel, specifically Mr. Chandrasekhar. Sir has been my well-wisher and mentor for a long time, someone who I respect a lot. Thank you, sir, for having me. It's a very interesting subject because currency kind of reflects what the economy is all about. Knowing the direction for the currency is paramount to the exporters and importers, because they sort of need to plan their hedges, and the exchange rate price movements kind of affects them in a big way. So with that background, I'll sort of get into my small presentation that I have today. I hope you're able to see my presentation. Can you see my slides?
No, sir, it's not yet shared. Yeah, something is coming up. Now, can you move to the presentation mode, sir? Slideshow.
Sorry.
Yeah.
So what I generally do when I look at the currency markets is see our currency against the other currencies and how they're performing, to get an idea about how much the local currency or rupee is overvalued or undervalued, because the RBI looks at it very, very closely and sort of takes a call when to intervene and when not to intervene, largely based on the REER, which is the real effective exchange rate. In fact, their calculations are much better than this, but roughly this is what they kind of look at and see how much our currency is appreciating or depreciating vis-a-vis the rest of the peers. So here I've just captured some of the important ones. Of course, Brent is something which I've taken because it has an impact on the currency play, because the current account deficit is something which will swell if crude prices continue to rise like this. So effectively that will weaken the currency going forward, but then our reserves are equally good at this point in time, if not the best at any point in time. So that might not happen, where it might depreciate purely based on crude prices rising higher. So the the takeaways from this particular slide is that you look at yuan and the dollar index. Both have appreciated. In fact, the dollar has fallen by 10%, and the dollar against the yuan has also fallen exactly by 10%. So earlier, the US, before Trump came in, I think there was a lot of complaints about currency manipulation and Chinese currency being artificially held. Um, that has changed a lot. So you can very clearly see from that. And all thanks to Trump and the way he's put pressure on Chinese. Now look at the rupee on the other side. We have done 4%, meaning we appreciated just 4% compared to a 10% appreciation in yuan, a 24% appreciation in the South African rand, a 14% appreciation in Indonesian rupiah. So the thing is that we will be doing a lot of catch up in the coming quarter is what I feel. Broadly based on if you look at the inflows and if you look at purely this comparison, there could be some catch up and we might appreciate a little bit more from here where we are. I think today it broke some key levels on the technical side, but then this is one of the things. There's a lot of pressure on the inflow side. I think there's a huge amount of inflows hitting the market, and that's seeing the rupee come under pressure more and more, meaning the dollar come under pressure against the rupee. So, in a nutshell, I think a potential appreciation is in the offing on the back of the stimulus which is being provided. Now, stimulus can work in different ways. There could be a very strong carry trade which can continue, which means borrowing in dollars at a lower rate of interest, and then deploying that funds in various asset classes, including the emerging markets. And since India has its own growth potential, I think there's a lot of money coming from different places, and that's hitting the markets in a big way. You can see the way the equity markets have completely shrugged off the fear of a first, second, or any third wave or anything of that sort, and it just keeps going one way. Thanks to the huge amount of stimulus and the growth potential that India shows. So a lot of dollars flowing in. RBI keeps intervening by buying them on and off. But when they see this real basket, which I just showed earlier, I think the other currencies are appreciating so much that they're forced to let it appreciate. Mostly what they do is they keep buying the dollars, one, to prop up the reserves, and two, to intervene and keep the dollar a bit artificially higher so that it supports our export market in a big way. Because if we have a currency which is depreciating, that will encourage exporters to sort of export more. And also, if the currency were to depreciate, that would put pressure on inflation further. Right now, I think the government is not worried about inflation, but if they let the currency depreciate and artificially hold it, that will lead to higher inflation, thanks to rising prices of commodities. So it will be a double whammy for the government. So for the best thing for them at this point in time is to let the currencies appreciate and cool off inflation to some extent. So the global interest rates are expected to stay ultra low very clearly. Like Mr. Nair said in his previous presentation, it's likely to go up at the end of the year, maybe beginning of next year. Very difficult to say, but one thing to keep in mind is Janet Yellen has already sounded the alert. She's already talked about it, though the market thinks that this ultra low policy will be kept, but she is not the one who will keep quiet. I think the minute she sees any overheating of inflation, she's going to act, because Fed does like that. They generally prepare the market ahead of anything. They won't do anything by surprise. So she's already sounded the alert. So my own personal feeling is that we could see inflationary concerns much earlier by the end of the year itself, or probably even before that. Um, I'm not betting that interest rates will stay ultra low for a long time. So that's my own personal expectation. And the uncertainty on trade deal with China still lingers. I think even though Biden has come, there are some hopes. But I think the the status quo will continue as far as U.S.-China relationship goes and the trade deal goes. So that's all weak for the dollar overall. All these factors are basically weak for the dollar. But if I were to get any kind of clues going forward on what the dollar would do, I think the employment numbers are the key numbers which I'll be looking for. And that would set the direction, and the Fed, of course, will be very, very closely watching it. And with the recovery that is expected in the US, the way the vaccination program is happening, if the third wave doesn't happen there, possibly you'll see a good recovery economically, and that will strengthen the dollar towards the last quarter of 2021. So there is a good chance that we would see the dollar reversing the end of the year, not immediately though, maybe a quarter or two later. But I see that clearly happening going forward, not at this point in time. But immediately there's a lot of pressure. I think the dollar is on its path to weaken more. One key, a couple of key things that I want to put here is if you look at the FPI flows, the foreign portfolio investments that keep coming and going, it's massive. I think it's hit a high of close to $27 billion just in the last fiscal. So you can actually see, the kind of inflows that RBI had to absorb to keep the rupee stable. And the growth forecast in 21-22 is pegged about 10%. Of course, there are because of the second wave, I think there's a lot of debate on these numbers. But largely, I think 10% or thereabouts is something which the market is expecting. And the FDIs, I think the FDIs have also sort of hit the roof. I think it's an all-time high. For the first time, we're seeing something like $72 billion. Largely coming from software, and Japan is one of the leading investors. Of course, we know that the trains which they're helping out, they're investing big time in that, and also the FDI window was opened this year from the budget. So that had led to huge amount of inflows that have come in form of FDIs. So we've had huge inflows hit the market, and a rupee which was almost around 77, 78 has started coming towards, we're closer to 73 now today, thanks to all these inflows and the way the RBI has been intervening. And one of the key things is Reliance's stake sale to various foreign players. So that has brought in a huge amount of inflows. Let's not forget they're still talking with Saudi Aramco. So God alone knows how much more can come in the coming year if that goes through. So we're sitting in a time when there is huge amount of forex reserves that are coming up, and a lot of inflows that are hitting. A rupee appreciation is looking inevitable purely based on this. To put it in one slide, the outlook for 2021 in one sentence is very hopeful. We'll have an appreciating currency. Is the expectations for economic growth? What are the expectations? I think better than other countries because we were least affected, but we're the worst affected now. But still, the prospects are looking good once we go through this. The tax cuts, are something which is talked about, but it's going to take a long time before it crosses the Congress and it's get passed. And absolutely no chance of a recession because I think the US has handled it well. The kind of money they're pumping in doesn't look like that at all. The dollar will clearly become weaker, and if things improve faster than expected from the pandemic front, I think the rupee could continue to strengthen more because our economy will benefit in a big way. Just a small slide about the rupee. This is the overall rupee chart, right from 2010 onwards to 2021, you can notice that there's a trend line. I think it's just about to break it. It's been holding it for almost 10 years. So just today, just as we're speaking, I think the currency is very close to 73 and about to break that. The charters and technical analysts call this a very important turnaround in any market. Forget about currency or commodities, but this is a very, very important trend line that's being tested now. So if 73 doesn't hold in the coming days, in the coming weeks, then I think we're headed much lower. And when that happens, I think we are first headed close to 69 or thereabouts, or 70. So that's a psychological level the RBI will try to defend. But with the sort of inflows that are expected going forward, I won't be surprised if it goes even to 65 in the coming year, or by April, by March 2022. So basically, my conclusion is that the Fed is expected to maintain the same position. I think the dollar will weaken. Crude prices are expected to rise, and that could pressure the current account deficit, but the reserve situation is comfortable. And the short-term view is that we'll see it appreciate to 69.70, and then in the third half, maybe go up towards 73 levels if the dollar were to sort of have a pullback. And then it would, in the last quarter, that is the Jan to March 2022, when the budget will be announced and more expectations will come and more inflows could come in. And that's a time when it could appreciate to around 65 or thereabouts. So with that, I'll end my presentation. Thank you very much. Thanks for listening.
No, thank you, Mr. Dhansekhar. A very interesting take on rupee, that it's going to appreciate and not appreciate just by a bit, but technically and fundamentally, it potentially can break psychological barrier of 69 and go all the way up to 65. Very interesting. I'll try and come back to you, but Madan, let me now come to you. We've looked at crop looking very good. The monsoon is supposed to be very, very good, normal, and more than 100% potentially. Oil is supposed to remain benign. Rupee might appreciate, but these are some of the factors. There are overall many more factors, growth being one, fiscal being another one, borrowing, debt to GDP, cost of borrowing. There are several other factors which RBI really needs to be bothered about. So, over to you to give us a lot more macro flavor of what's in store for inflation.
Thanks, Atul. In fact, before I get to what Atul has asked, I'm very much tempted to comment on the dollar, because I think Dhansekhar has provided a very cogent view based on his analysis about how the rupee will be appreciating. In fact, our call is actually that the rupee is going to depreciate. I'll just spend a few quick moments on this without getting into too much of details. Because if you look at what really drives the rupee, I think it's more of the fundamentals, and then there are the external factors. If you look at the fundamentals which go by the balance of payments, I think we do expect the trade deficit to widen, the current account deficit, which currently is in the surplus, that is the current balance, to really turn to a deficit. And we are not that gung-ho about the same kind of foreign institutional investment funds coming in. So even the capital flows will tend to be a bit more moderated. So therefore, there would be overall a tendency for the rupee to depreciate purely from the point of view of the current of the balance of payments. Now, in terms of external factors, I think one thing the way we are looking at it is that currently we are seeing that the dollar is weakening against the euro, but in course of time we're expecting the dollar to strengthen, and as the dollar strengthens, we can see that the other currencies will weaken. So I think that external factor, which has provided a lot of buoyancy towards appreciation, may probably not be there to the same extent as it was there in the previous year. So that would be one factor. And we should also remember the other factor of the Reserve Bank of India. If you remember when the credit policy came out and the RBI took a very dovish view and something which is going to persist for this year, we saw the rupee actually went towards 75 to a dollar. So, and I think with this kind of stance being maintained, our feeling here at Care Ratings is that the rupee would tend to depreciate, and the RBI would probably be happy with it. So we're looking at a level of around 74, 74 and a half. So it's nothing close to what Gyan Shekhar had said, we can probably meet next year and find out who was really right out there. Now, coming back to this issue of inflation, when we look at inflation in India, we actually use two concepts. And the reason I'm going to this is that they actually they have been giving a different sense in the last year, where we saw that the WPI inflation number was just about marginal negative in most of the months, whereas the CPI inflation was much higher in the region of around 6-7%, something which did cause a lot of concern. The difference is, of course, one is closer to being a purchaser's price index, whereas the other one is more of a consumer's price index. So the composition of these two indices were quite different. So if you look at the factors which have been affecting them, they have also been different. Even something like agricultural commodities, they tend to have a greater effect on the CPI because of the number of intermediation, the levels of intermediation which takes place between the wholesale and the consumer level. So while the WPI for cereals or for pulses was showing a smaller number, we saw a much higher number coming for the CPIs, primarily on account of the intermediates who are there. So in fact, when you're talking of this intermediation, I think as we saw supply disruptions last year, which is again being witnessed today, especially in terms of the transportation of commodities, there would be a tendency for prices to again increase. So let me just give a perspective about how we're looking at the WPI. So the WPI had statistically registered negative growth rates, very marginal, something of around 1-2% last year. So it's but natural that the numbers are going to be very high this year. And we're looking at something closer to the region of around 8-10%, which may not really be bad from the point of view of industry, because what we felt was that if you look at a manufacturing sector, I think you require a certain minimum inflation to remain profitable. And what we saw last year was that the pricing power of a number of corporates came down, primarily on account of the pandemic, demand conditions being low. So when we see that the prices are going up, like if you look at the WPI, which came out yesterday, which came at an all-time high of over 10%, something which we think is going to persist for the greater part of this particular year, more because of the statistical reason. I think this has been a good boost which has been provided to the manufacturing sector, provided it can be retained. And if you look at the World Bank data, look at what Chandrasekhar has spoken of, you see what Siraj has spoken of, all this actually gives you a feeling that prices are not going to smoothen anytime soon. And therefore, the WPI index will also be showing something more in the upward region for all the three components which you're talking of. And now, an interesting point is about crude oil prices remaining at 65. Does it really make sense for us? Does it really mean anything to us? Because what we have seen in India is that, notwithstanding the fact that crude oil prices have been coming down, as consumers, we end up paying almost the same price. The price never really changes because of the rather warped tax structure which we have. So even today, for example, if you look at the final price of petrol or diesel which you're paying in the market, it's say in the region of 90 to 95 rupees, depending upon which location you are in. And if you see the actual cost of processing plus your dealer's commission, not more than 40% of the overall price which you're paying is actually meant for, is going to the oil producers or to the dealers. Most of it is going in the form of taxes. So what the government really does is they make sure that when crude oil price, international price comes down, they ensure that the benefit doesn't come fully to us. Maybe we may get a 1 or 2 rupees benefit, which we get in terms of the price coming down. But most of it is actually taken up, collected by the governments, both the state and the center, in terms of your VAT or in terms of excise duty. So finally, at the end of the day, we don't see any major benefit coming here. So that's one of the reasons why we feel that while the international price of crude is important in terms it's going up, because if it goes up, we are always scared that we may be ending up paying more than 100 rupees for a liter of petrol. But when it comes down, it actually doesn't really matter in terms of the price indices which we're talking of, either the WPI or the CPI. Now, if you look at the CPI, it has a different kind of a composition. We have around 45%, which is going for food commodities, and the rest will be going for non-food. And if I just take you back last week when we had this interesting number which came out of CPI inflation being 4.3%, I think there was a lot of cheering to say that, okay, food prices have come down and inflation is going to be, has come down. But we have seen that, again, I think the problem with all these indices is that when we are talking of base effects, we had a high number last time, we'll have a low number this year. If I have a low number this year, I'll have a high number next year. So even here, we saw that in case you remove the inflation for vegetables, for example, which had something like a 14% decline, the overall index would have actually been showing still something like 5.6, 5.7%. So our sense is that the consumer price index inflation is going to remain in the region of 5 to 5.5% per year. I don't think there's going to be any relief out there. If you look at core inflation, it's going to be more into the region of 5.3%. Because if you're looking at other components, especially in the core sector, lots of them are based on the MRP concept. That's the maximum retail price. So last year we saw on account of the dislocations which took place, prices tended to go up, raw material prices went up, services costs went up. And once these costs go up, they rarely come down again. So we'll have to probably be prepared to bear up with these higher prices for non-food items for the entire 21-22, which means that there will be an inherent tendency for the consumer price index to keep registering numbers of around 5.5% more on a consistent basis. So this is going to be the inflation scenario where we will be having a high inflation numbers. But the next question is that, again, does this high inflation really matter or not? So I think an interesting point made by the RBI in the last policy, which was the first policy for the new financial year, is that while the MPC will be targeting inflation, but they are also looking in terms of growth. So they're not going to be stuck to this case of saying that because we have high inflation, we're going to increase growth. So I think there's been some kind of a separation between inflation and growth priority for the central bank. Started off last year. Last year it was probably expected because even though we had high inflation in the region of around 7 to 8% for quite a few months, the RBI still decided to keep the repo rate unchanged. In fact, over the year, we had seen a 50 basis points cut in the repo operation, in the repo rate. And they had focused more in terms of provision of liquidity in order to make sure that growth could take place. So I do expect that even for the current financial year, we will not be seeing any changes in interest rates as such, but there would be surplus or an influx of liquidity coming in the various forms of open market operations, long-term repo operations, targeted LTROs, to ensure that there is enough liquidity in the system and that interest rates remain generally stable as far as the corporate sector is concerned. Thank you.
Thank you, Malan. So you bring in a very interesting perspective, even on rupee, that from your perspective, it's going to be around 75. So we now have on our panel a discussion between 65 and 75. But we'll leave that for a while aside. Let me just continue with you, Madan. In terms of your own inflation outlook, you say that RBI will continue to look at growth as an imperative and would continue to focus on growth. The inflation, whether it is CPI or WPI, you expect it to remain below the upper circuit of 6%, which even RBI is very hopeful that it would remain below 6%. Now, if that be the case, my question to you is that given the global developments which people are expecting, including one of our panelists mentioned that the US may increase the rates either before this calendar year end or before the financial year end. So, that's going to have its own impact on the currencies, on the crude. And also, can RBI continue to ignore such global developments and continue to maintain a domestic focus on the inflation, ignore or rather monitor the inflation, but focus on growth? Over to you, Madan.
Actually, I think the point you've made is very, very pertinent. But see, the RBI has always maintained that monetary policy decisions are based on domestic considerations. And while they do look at what's happening globally, but they would not be following what the Federal Reserve does just in terms of whether they are lowering the rates or they increasing the rates. So unless there are any serious distortions which take place in, say, the currency market, for example, at that particular point of time, there may be a reason for the RBI to intervene. But now, if I take a midpoint between my pessimism for the rupee and Gyan Shekhar's optimism of an appreciation, I think in the current year, we may not really reach a situation where there could be a conflict in terms of saying like what we had, I think, before Dr. Raghuram Rajan took over when we had the Forex crisis. I don't think we're looking at that kind of a scenario in any which way. So in terms of the currency markets remaining more or less stable, and as I told you, some a little bit of depreciation may actually be good, something welcome, because from the point of view of exports, we're also looking in terms of exports increasing this year. So the RBI may not be too concerned about it and will still continue to focus on growth. Because I think that's something which appears to be wobbly today, given the second wave which is taking place.
Sure. So, let me now turn to you, Raj. You mentioned a very important point as to, we need to look at where the world is going to go, especially from the geopolitical perspective, and its impact on the crude prices. And that was an open question you had left. And I just want to pick up from there on that, we have two events geopolitically which are probably occupying everybody's mind. One is the Ukraine, Russia, and the other is Israel and the Palestine. And if any of these were to spin out of control, it would have substantial impact on crude and obviously on the higher side. Now, how do you see if those were to actually fructify, those events were to fructify, or one of them were to fructify, it would have an impact on crude. How do you, in your mind, think RBI should evaluate that? Because that's going to be a spike, but can it remain there? What should be the RBI's take on such eventuality? Over to you, Raj.
Yeah, Atul, that's a good question. There are two hotspots. You've pinpointed the two hotspots. The question is, if it happens, we have to deal with it. But I want to first of all evaluate whether that can happen. And the two situations are totally different. One is where the Arab-Palestine stuff, the Israel-Palestine stuff, where you can see that for the first time in the last few months, Arabs have a very different position and vis-a-vis Israel. Okay, no more hostile. Even now, they have not gone and condemned. It's only in a separate forum that Mohammed bin Salman said this is not good. But otherwise, he's been saying, look, let's have peace. And very same day after this escalated, they got hold of Egypt to send a security team to negotiate with Netanyahu. That's on Wednesday. But they've not said, we will do this, we will do that. This is not the old Arab Nations League. Okay, it's a different Arab circuit. They're only saying, let's not have war. Okay, now, neither does US want war. The US has allowed Israel to do what? Teach the Palestinians a lesson, teach within quote, and then said, now go for peace. The only thing that can disturb the whole thing is Iran decides that Hamas is getting hammered too much. We got to intervene and do something. In which case, from their 16 bases in Syria, they can start bombarding Israel. Now, I think US wants to prevent that from happening. Even Israel does not want that to happen, though they can retaliate. They'd rather have to deal with this. They just want to weaken Hamas and not bring him to a point where they'll need help from Iran. So if Iran stays out of it, I don't think this is going to break out of control. Right now, why is this happening? Why is this belligerent attitude over Israel? Netanyahu's political future is uncertain for the last 2 years. The way he can do it is to look like a hero, equivalent of a 56-inch. He has to look like a hero. And he wants to this time try and do it without a coalition partner because it's failed 4 or 5. How many more elections can he have? So he wants to emerge a hero and then call for election. And meanwhile, he'll show them, look, I saved you guys. I mean, he wants the Israelis to see that. The idea is not to get rid of Hamas. Okay. So he will want his international brownie points next week, not now. But right now, teach a lesson to make sure that Israelis think that he is the leader. Forget about the corruption charges. Forget about the fact that the politics is fractured. So I don't think it's going to get spun out of control. One more reason I think it will not spin out of control is Iran is now torn between two things. One is it has to be against Saudi Arabia and against Israel always and support Hamas, whom they've been covertly supporting. And against that, they have also got to weigh the possibility of the US embargo going off if Biden agrees to some of their terms. So they don't want to jeopardize that US embargo going off. Even Europe is supporting the lifting of the embargo. So I don't think they will go crazy at this stage. So my own feeling is that it's not something we need to worry about. Netanyahu wins his brownie points and the matter gets over. I'm oversimplifying it, but this is my view. Whereas on the other side, it's more complex. Ukraine is more complex. Russia has done a number of things. It's taken away Crimea, effectively taken away Crimea. It's also looking at other provinces next to it. And Ukraine wants to fight back. Ukraine has asked Europe time and again to be admitted into NATO. US is saying go easy. We can't do that as yet. We'll support you. US has sent 2 ships, warships to that area yesterday to tell Putin that, look, we're not going to take it easy. Now, Putin doesn't like a stalemate where he has threatened Ukraine. What is, let's say, what does Putin want? He's not interested in a conflict. He wants to combine Russia, Belarus, and Ukraine into one country again. Just these 3. It's very strategic for him because all the gas pipelines from Russia pass through Ukraine to Northern Europe or Western Europe. They don't want a country which is not that friendly to control the gas pipeline. And Belarus has always been their lapdog. So Belarus and Ukraine and this will be a perfect solution for Putin. But right now he's being checkmated. So it's some kind of a stalemate. And Putin doesn't like stalemate. That's not the way he's built. He's a KGB guy. You should have seen him when he came and gave a talk at the Oberoi a few years ago when he had called some of us there for a talk. He's KGB. He wants to, that's why it's complex, not that easy to solve. So we have to watch that part very carefully. It will not be annexation of Crimea, of
Ukraine. Sure.
Not going to be that, but it will be chipping off a little bit just so that I have one.
Sure.
So I'm not that worried that things are going to go out of control, but it is a hotspot, and so is Palestine. You're right in calling them hotspots. It will create uncertainty. In many commodities, even uncertainty is enough to create price going up. So I don't know whether I've answered the question adequately.
No, sure. No, you brought some insights that, bringing in the Iran angle, the Netanyahu angle, and, we need to really focus not on the Israel, Palestine, but maybe a more strategic developments happening on the Western world, which is the Ukraine, Russia. And yeah. I know that Germany, for example, depends on Russia for 99%.
Yes.
And if Russia just switches off a button, Germany could freeze to death. So
right.
There are those
right.
political sensitivities, democratic sensitivities, and it's kind of a lot more complex. Completely agree with you. We have time just for a 2 to 3 minutes question. So, let me come back to you, Mr. Gnanshekar. It's a very interesting point that Madan made, which is an economic perspective he's brought in. And, when the rupee actually depreciated from 74 level to a little over 75, I was talking to several players, technical and fundamentalists and stuff like that. And they were all telling all the exporters that go and keep your interests open, but hedge your imports. How would you, in a very 2 to 3 minutes, if you can explain if that kind of, what's your thought on that? What's your advice to the exporters at this juncture?
Well, clearly to hedge, because, the most important thing for me, it's my word against Madan. Only time will tell, like you rightly said.
Sure.
Next year we'll come to know whether the rupee depreciated or appreciated. But the reasons which I think very strongly that rupee could continue appreciating is the kind of inflows that are going to hit the market. It's not just the end of it. There's a lot lined up in by way of FDIs. And also, if you look at the overall picture, I'm pretty convinced that the technical picture I'm talking about, because finally, technical analysis is nothing but price movement. You look at price movement and take a call. So price discounts everything. All the fundamental factors that we talk about, price discounts. And it's a first to always indicate something which is going to happen. So on the technical front, I'm seeing a lot of changes. And in fact, my bias is always on the technical side. And then I look for substantiating factors which can help it going forward. So I'm convinced that we are headed lower. Maybe 65 is a bit on the extreme side. I think 69, 70 itself will be a very strong support. I think RBI will try to defend that. Like Madan said, I think exporters will be taken care of. I think there will be a lot of intervention at that point in time. But my belief is subsequently we might head towards 65, which is in the last quarter of 2000. The first quarter of 2022, which will be during budget, and there will be more inflows that might come.
Sure.
That's the basis on which I'm looking at 65. But I think 69 or thereabouts itself will be a very, very good level where it will be held.
Okay. Okay, so importers might benefit if the rupee actually appreciates, if they keep it open, and exporters need to kind of hedge themselves in a depreciating rupee. But we have a triangle. We have a fundamental view, we have a technical view, and we have an economic view. And time only will tell us. I think we do not have time to come to you, Mr. Chandrasekhar, but I would like to—
1 minute.
Sure,
I need
sure,
1
sure.
minute
Okay.
if you have.
Sure.
And I have a slightly contrarian view on crude oil. I'm actually bullish on crude oil, primarily because one, globally oil demand is recovering. We track these demand recovery month on month. In spite of problems in India, we are the third largest importers. But in spite of the problems in India, world demand is very, very clearly recovering.
So what's your call on March 22? What's your call on March 22?
OPEC plus. They're very disciplined in their production. Okay. And number three, lower for longer. The lower interest rate for a longer period of time. All this will combine to push the crude oil prices. I'm looking at $65 to $70 in the second quarter, which will end now in June, and $70 to $75 in the third quarter. And I'm looking at only the next 4 to 5 months. So I will not be surprised if it's 70 to 75 in the third quarter and 65, 70 this one.
And this does not include any political shocks.
Yeah, I mean, under normal situation, put it this way.
Sure. Understood.
Iran wants to get out of this embargo. Obviously, they are in talks, but Iran is going to have presidential elections next month. We don't know who's going to come. We don't know what is going to be his attitude towards the United States. But even otherwise, a lot of Iranian oil is going to China. And China is actually defying US embargo and buying from Iran. Therefore, we need to, therefore, even if Iran were to come after lifting of embargo, there's not that the world is going to be flooded with oil. There will be some incremental supplies, but not flooded. Therefore, I'm a little bullish on oil for the rest of the year.
So very interesting panel. I must say that, we've seen multiple views on the crude and the currency. On the crop side, we obviously are seeing that it's going to be a much easier in terms of the prices. So if you were to kind of combine all the three, the crop is going to look something which is probably under control. So RBI should be at ease when it's looking at CPI, where with 45% food inflation weightage. So RBI should be at ease. Besides, the growth outlook and the imperative for the growth overrides the inflation concern as far as RBI is concerned. Again, a comfort zone for RBI. Crude and currencies, we have diametrically opposite views from the panel, which is good, but I wouldn't say that they are so drastically away from each other in terms of the numbers that it could destabilize the economy or destabilize the entire view or the entire hedging mechanism that the government follows for certain of its commodities, which have an impact on overall the wholesale price inflation. We have time for maybe 1 or 2 questions. So Selvi, over to you. Let me thank the panel wholeheartedly. Excellent discussion, very open discussion. And the diametric views only help us kind of question ourselves more and find out more in detail going forward. Maybe over the next 2 months' time, we'll have another panel and take these specific views forward. Over to you, Selvi. Thank you, everyone.
Thank you. Mr. Juzer Khorakiwala, Vice President IMC, would like to ask a question. Over to you, sir.
Yeah, thank you. I just have a comment. I read somewhere that recently China has committed to invest $400 billion in Iran over the next 25 years, and this will be paid for by way of oil. This came in some news report which I read some time back. If that is true, then what is going to be the impact of oil, oil prices? Because Iran has got a commitment of $400 billion of oil supplies over 25 years, of course. So that changes the geopolitics of the whole situation if this is true. Any comments from the panel?
First, let me invite Mr. Nair to speak, and then
Yeah,
maybe
sure,
Mr.
sure.
Chandrasekhar, you can comment
Yeah,
later on.
Sure, sure.
Over to you, Raj. Thank
My
you.
view is that the more China buys from Iran, it's already buying. The more it buys from Iran, the more the total supply, the less they'll buy from others. Okay, and there might be some sweet deals also on pricing, on long term, because of long-term money in investment in infrastructure and so on and so forth. Therefore, it will actually bring the prices, control the prices rather than let the price go up.
Right, right. Mr. Chandrasekhar?
On the other hand, look at it this way: $400 billion over a period of 25 years would be roughly $12 to $15 billion a year, which is no big deal really for China.
He's talking billion.
No,
Billion.
Billion.
Yeah, Bombay.
Yeah, billion. Yeah, that's right. That's what I'm saying.
That's what I read.
So over 25 years, 400 billion is no big deal. Every year it'll be about. Number one. Number two, Iran's production capacity is something like 3.5 million barrels a day, and China is already buying 65 to 70% of that production. And therefore, even if they tie up, Iran is not going to be able to substantially step up its output. Its output will go to the maximum production capacity that it has, all of which probably China will buy, which is fine. So to that extent, the world market will be supplied extra from Iran. But there will be other factors. For example, India's demand will also start to improve, hopefully from next year. The US demand will start to improve. Other countries' economic growth will improve. And therefore, overall demand for crude oil is going to go up around the world. And the call on OPEC's oil will only increase with Iran exclusively supplying to China. But Iran is not going to be able to meet all of China's demand. That is the point.
That's true.
Sure. Selby, you have any other questions? Selby? Hello? Selby?
There is one more question in text.
Yeah.
Hello? Hello?
Yeah, go ahead, Selby. We can hear you.
Yeah. Okay. So I was just reading out question.
We have lost you, Selby. We have lost you. We can't make out what you're saying.
So then I think go for the vote of thanks. Hello.
I couldn't figure out, Selby, what was said. Did anybody from the panel could make out? No.
No,
Selby, you'll have to
voice
repeat,
is breaking,
Selby.
but we can look at the chat box for all the questions.
No, I think she towards the end said vote of thanks or something like that.
Okay. In which case, I think it's 5 o'clock. So yeah, Vice President can.
Yeah, can you hear me? Thank you so much. Yeah, good evening, all of you, and good evening, all the participants. I think we had a fantastic participation and a very, very interesting understanding of 3 C's: crude, currency, and crops. We do live in a very volatile world where we don't know how prices get impacted or affected. And certainly we have had contrarian views, especially on currency. So it only shows how difficult it is to predict what's likely to happen going forward. So I must thank all our panelists, Mr. Raj Nair, Mr. Nanshekar Tyagarajan, Mr. Chandrasekhar, of course, and Mr. Madan Sabnavis for their excellent presentation and a free and frank discussion that we have had, and an excellent moderation, of course, by Atul Joshi. So thank you very much for this, and thanks the IMC Secretariat for having this organized. So thank you once again, and good evening to you all.
Thank you. Bye-bye.
Thank you, everyone.
Yeah, thanks and bye.
Thanks, Mark. May I leave? Yeah.